Hello students, 12th Accountancy, Unit 5, Admission of Partner, Goodwill Treatment. What is goodwill? Goodwill is the good name, reputation of the business. So, the goodwill will be under the fixed assets in the balance sheet. It's a intangible assets, we can't see. It's a good name by rendering service to the public, it was earned. So, it's a reputation of the business. It shows when a new partner is admitted, in that time the goodwill of the partnership firm will be valued, because the new partner, when he is going to admit to the partnership firm, he is going to utilize the existing partners hard work. For that he has to contribute some amount to the sacrificing partners. Now we see here accounting treatment for goodwill and admission of a partner. When a new partner is admitted to the partnership firm, what are the accounting treatments should be done related to the goodwill? 1. When a new partner bring cash towards goodwill. When the new partner bring the cash towards goodwill mean the goodwill amount will be distributed, shared among the existing partners, that is sacrificed partners. Sacrificing partners, they will share the goodwill amount. When the new partner does not bring goodwill in cash or in kind, the new partner does not bring the goodwill amount mean the goodwill amount it will be transferred from the new partner's capital account. Anyhow, the new partner have to bring goodwill capital amount compulsory. So when he brought the capital amount, from the capital amount, the goodwill share will be transferred to the sacrificing partner's capital account. The third one, when the new partner bring only a part of the goodwill in cash or in kind. So in the second one and first one, this combined one is third one. Now we see here, when the new partner has to bring 10,000, but he brought only 5,000 in cash. Remaining 5,000 he didn't bring. In that time, the amount which he brought, that is 5,000. This 5,000 will be shared among the sacrificed partners in their sacrificing ratio. Remaining 5,000 will be transferred from the new partner's capital account to old sacrificing partner's capital account in their sacrificing ratio. So the remaining 5,000 also will be taken. Then existing goodwill in the partnership firm, existing already in the balance sheet, goodwill is appeared mean the existing goodwill will be distributed among the old partners capital account in their old profit sharing ratio. Now we can see one by one. When a new partner bring cash towards goodwill, this treatment already we have done. When the new partner bring cash or assets for the goodwill mean this amount will be distributed to the sacrificing partners. So what comes in cash or asset? So cash account debit to sacrificing partners capital account. In the sacrificing ratio it will be distributed. Suppose when the new partner bring assets mean concern asset account debit to old sacrificing partners capital account. In the sacrificing ratio the amount will be distributed. The next one, for withdrawal of cash received for goodwill by the old partners. Suppose the amount which is transferred from the new partners goodwill amount to the old partner's capital account. The amount is withdrawn by the old partner mean cash is going outside from the capital account. In that case, old partner's capital account debit to cash account. Normally how the partner withdrawn the amount mean what is the transaction we will do? The same transaction entry. Old partner's capital account debit to cash account. Now we are going to learn the second situation, when the new partner does not bring goodwill in cash or in kind. In that time, the new partner's capital account, from the new partner's capital account, the goodwill amount will be transferred to the old partner's capital account. For that the journal is given new partner's capital account debit to old partner's capital or current account. Capital mean already we know that if it is a fixed capital method we used to use the word current account. Fluctuating mean we use the word capital. So in the sacrificing ratio the amount will be distributed. So now we can see the sum. Illustration number 21. Ashok and Mumtaj were partners in a firm sharing profit and losses in the ratio of 5:1. So their profit sharing ratio is given here 5:1. So for Ashok 5/6 and Mumtaj 1 by 6. So their proposing ratio is given. Profit sharing ratio. They have decided to admit Darun into the firm for 2 by 9 share of profits. So Darun is a new partner. He is admitted. His future share of profit also given. The goodwill of the firm on the date of admission was valued at 27,000. So now they have given the firm's goodwill. The firm's goodwill, not Darun's. So the entire partnership firm goodwill value is 27,000 when a new partner is admitted. So this 27,000 amount, not whole amount, should be brought by the new partner. From the 27,000, for the new partner, his share alone he has to bring. So his future profit sharing ratio is 2 by 9. So 27,000 into 2 by 9, that is we got 3,000. 3,000 into 9 is equal to 27,000. So 3 into 2, 6,000. So Darun has to bring 6,000 rupees. Darun has to bring rupees 6,000 in the name of goodwill. So now you see here the firm's total goodwill value 27,000 is given. From this 27,000, Darun has to bring his share of goodwill alone. 2 by 9 alone he has to bring. So the 6,000 amount has to be brought by Darun, the name of goodwill. Darun is not able to bring in cash for his share of goodwill. In that case, what they said, I mean, Darun didn't bring the goodwill amount. He didn't bring the goodwill amount. Pass Nasir John entry for goodwill and assumption that the fluctuating system, capital system is followed. So now we see here, now Darun is admitted to the partnership firm. He didn't bring the cash. For that, what is a John entry? When the new partner didn't bring the cash for goodwill, mean new partner's capital account debit to old partner's capital account credit. So new partner's capital account, how much he has to bring? 6,000. He didn't bring. Actually, if he is going to bring the cash, mean cash account debit to old partner's capital account, we used to place it. Now he didn't bring the capital amount. So now what we have to do, mean from his capital account we are going to transfer. So new partner's capital account debit 6,000 to old partner's capital account 6,000. Who are the old partners? Ashok and Mumtaj. So in that case, to Ashok's capital account, to Mumtaj's capital account. The sacrificing ratio is given. Now we see here, if you want to calculate the sacrificing ratio, mean you need two things. One is old ratio and the new ratio should be there. Here we have old ratio 5:1, but they didn't give the new ratio. So first option is clear out. Then second option, what they have to give, mean the proportion of shares sacrificed. Proportion of share sacrificed. Ashok, how much he sacrificed share to Darun. The same way, how much Mumtaj sacrificed for Darun. That also should be given. That also not given here. So both the option is not available. So old profit sharing ratio 5:1. Old profit sharing ratio 5:1. That is considered as a sacrificing ratio. So this 6,000 amount will be distributed in the ratio of 5:1 to the old partners of Ashok and Mumtaj. So Ashok will get 5,000 and Mumtaj will get 1,000 rupees. So we can pass a journal entry. New partner Darun's capital account debit 6,000 to Ashok's capital account. Ashok's capital account 5,000 to Mumtaj's capital account 1,000. It's a journal entry is given here. So Darun's capital account, from his capital account we are going to transfer the amount 6,000 to the old partners. 6,000 is given. This 6,000 is distributed to the old partners in the sacrificing ratio. Actually here sacrificing ratio, to calculate it, no provisions are available. So old profit ratio is taken as a sacrificing ratio. So 5,000 and 1,000 is shared to Ashok and Mumtaj capital account. The next one, when the new partner brings only a part of the goodwill in cash or in kind. So when the new partner bring a half of the amount for goodwill, in cash, remaining part he didn't bring, mean how much he brought, the amount, that amount should be shared among the partners in the capital sharing ratio. The same way, the amount which didn't bring, that should be transferred from the new partner's capital account. So journal is given here. The cash account debit, how much he brought, that should be entered. Then remaining part amount should be transferred from the new partner's capital account. So new partner's capital account debit also given to old partner's capital account. So we can see the sum now. Aravind and Balaji are partners sharing profit and losses in the ratio of 3:2. So now we see here two partners are given, Aravind and Balaji. Aravind 3 by 5, Aravind 3 by 5 and Balaji 2 by 5. Their sacrificing ratio, their old profit sharing ratio. They admit Anirudh into the partnership. Anirudh is new partner. The new profit sharing ratio is agreed to 1:1:1. Now you see here, they have given the new profit sharing ratio. So we have to calculate the sacrificing ratio here. Sacrificing ratio is equal to old ratio minus new ratio. Old ratio is 3 by 5. So 3 by 5 minus 1 by 3. 1 by 3. So 1 by 3 for Aravind, 1 by 3 for Balaji, 1 by 3 for Anirudh. So 3 by 5 minus 1 by 3, when you are going to subtract it, we will get the amount, we will get the sacrificing ratio for Aravind. The same way we have to calculate the sacrificing ratio for Balaji is equal to 2 by 5 minus 1 by 3. That is the sacrificing ratio of Balaji. Okay. So first you have to calculate the sacrificing ratio. Second thing, Anirudh's share of goodwill is valued at 20,000. Now you see here, Anirudh's share of goodwill. In the last sum they have given the firm's total goodwill amount is mentioned. But here they have given the particular partner's share of goodwill is 20,000. So this 20,000 amount is a total goodwill amount. So from the 20,000 he pays 12,000 in cash. So 12,000 rupees he brought in cash. Remaining 8,000 about, they didn't say anything else. In that case, the remaining 8,000 will be transferred from the new partner's capital account to the old partner's capital account. Already you know the journal entry. Now you see here past necessary journal entries for goodwill and the assumption of fluctuating capital method. Fluctuating is given. So now they ask us to pass only journal entries alone. So you see here, for passing the journal entry, part of the cash brought mean cash account debit. How much he brought? 12,000. So cash account debit 12,000. Then remaining amount 8,000 he didn't bring. Total goodwill is 20,000. So cash account debit 12,000. Who is the new partner? Anirudh. Anirudh's capital account debit 8,000. So 20,000 is tallied. So this amount 20,000 is going to be distributed to the old partners, to Aravind capital account, to Balaji's capital account, their sacrificing ratio. For distributing this 20,000 total amount, we need to calculate the sacrificing ratio. Now we can see the sacrificing ratio. So you see here, sacrificing ratio is equal to old share minus new share. So already they have profit sharing ratio is 3:2. New profit sharing ratio is 1:1. So now we see here 3 by 5 minus 1 by 3 is given for Aravind. So first we have to, so the denominator should be equal. For that we are going to have the cross multiplication. So 3 by 5 into 3 by 3 into 3. 3 by 5 into 3 into 3. So in that time you see here 3 into 3, 9. 3 into 5, 15. We got it. The same way minus symbol is given. 1 by 3 into opposite cross 5 by 5. We are going to do 1 into 5, 5 divided by 15. So we got the value 9 divided by 15 minus 5 divided by 15. We have subtracted the value. We got the value as 4 divided by 15. 4 divided by 15. So we got the value. Next, we are going to calculate for Balaji the same way. 2 by 5 minus 1 by 3. We got the sacrificing ratio also 1 by 5. So now we got the sacrificing ratio is 4:1. Sacrificing ratio is 4:1. Now you see here the amount 20,000 is distributed among the old partners in the ratio of 4:1. That is 4 by 5. 1 5 is 5. 4 5s are 20. So 4,000. 4,000. 4,000 to 5, 20,000. So 4 into 4, 16. So 16,000 for Aravind and 4,000 for Balaji. 4,000 for Balaji. This amount will be distributed among the old partners. Now we see a journal entry. Cash account debit. How much he brought cash? 12,000. 12,000 is entered. From Anirudh's capital account, we are going to transfer the remaining balance amount 8,000. So 8,000 Anirudh capital account is given. The total amount 20,000 is distributed to the old partners capital account in their sacrificing ratio. The sacrificing ratio now only be calculated 4 by 5. So 20,000 into 4 by 5 is equal to 16,000. Balaji also we have calculated to Balaji's capital account 4,000 is entered. The next, existing goodwill. If the existing goodwill appears in the books when the new partner is admitted. In that time, the existing goodwill will be distributed to the old partners in their old profit sharing ratio. So old partners capital account debit to goodwill account to close the goodwill account. Sadis and Sudan are partners in a firm sharing profit losses in the ratio of 4:3. So the profit sharing ratio is 4:3. 4/7 for Sadis and 3/7 for Sudan. On 1st April 2018, they admitted Sasi as a new partner. On the date of Sasi's admission, goodwill appeared in the books of the firm is 35,000. So goodwill appeared in the books. In that case, the balance sheet already the goodwill value is appeared 35,000. By assuming fluctuating capital, pass the necessary journal entry. So now they ask us to pass the journal entry for closing the return of the goodwill, existing goodwill. What is existing goodwill? Return of journal entry, old partners capital account debit to goodwill account. So now you see here the 35,000 is going to be written off. So old partners capital account debit to goodwill account 35,000. So to goodwill account 35,000 is closed. But debit alone we have to compensate. So now you see here what are situation they have given to us. Write off the entire amount of existing goodwill. So the entire amount is going to be written off. That case 35,000 into 4/7. 177, 5 7s are 35. 5,000 to 4, 20,000. So 20,000 for Sadis. Remaining 15,000 for Sudan. Remaining 15,000 for Sudan. So first transaction we can do that. Write up the entire amount of existing goodwill. Heading narration you can write it. John and Dream. Who are the old partners? Sadis. Sadis capital account debit 20,000. Sudan's capital account debit 15,000. To goodwill account 35,000. So first journal entry is over. First journal entry is over. So the entire amount is written off. Suppose now they ask us to second situation. Now you see here what is the second situation? They ask us to write off only 21,000 allowed. Write off 21,000 allowed, but available amount is 35,000. So 35,000 minus 21,000 is equal to 14,000. So 21,000 alone will be written off. Remaining 14,000 will be appear in the balance sheet. So we no need to bother about the remaining amount. We are going to consider only 21,000 alone. How it is going to be distributed? So 21,000 is going to be distributed among the partners in their old profit sharing ratio. So already we know the old profit sharing ratio 4/7 for first partner. 1 7 is 7, 3 7s are 21. So 3,000 to 4 is equal to 12,000. So 12,000 for Sadis and 3 into 3, 6. Sorry. 3 into 3, 9,000. For second partner, 9,000 we will get it. Because here 3 will be the for second partner. Okay. So 12,000 is to 9,000 amount we are going to distribute for old partners in the write off only 21,000 second situation. So the same journal entry. Sadis capital account 12,000 debit and Sudan's capital account debit 9,000 to goodwill account 21,000 we have to enter it because only half of the amount is going to be written off. So for that also we can see the journal entry. Sadis capital account debit 21,000 only they ask us to write off. So 21,000 to 4/7 12,000. The same way 21,000 to 3/7 9,000 to goodwill account 21,000 is given.